Hi guys, so in this video I'm going to be talking about imbalances on the footprint and how we read them, um, and how we can use them to gauge the aggressiveness of market participants in the auction. But before I do that, I'm just going to touch briefly on how I read the footprint um, with the numbers you see in these columns, because we don't read it horizontally, we read it diagonally. Okay. That is because, let me just write this out. We have the bid side and we have the ask side. So the bid is what I'm referring to, the left-hand column there, and the ask is there. Okay. And we also know that to be a buyer in the market, there's two ways you can buy the market. You can be an aggressive participant. By that, I mean market executions. So you're just going straight to market, hitting the buy button as such. And that shows up, as we know, on the right-hand side on the ask. So aggressive buying. Or you can also enter with passive limit orders. So buy limit orders, they show up on the left-hand column. So passive buying, aggressive buying. Okay. And the same goes for the sellers. You've got aggressive selling and you've got passive selling. So the aggressive market executional orders show up on the bid side as market participants are attacking the bid, or they could also participate with their sell limit orders, which show up on the ask side. Right. So there's basically two prices in which they can trade, on the bid or on the ask. And how I read it and what is industry standard is diagonally. Is for a price to tick up, you need a seller. So for every buyer, you need to have a seller to match it at that price. So to sell, so to buy a market, you need a sell. To buy the market at this price, you need a seller who's willing to accept that order, and the market would tick up, and vice versa for the other side. So that's why we read the market diagonally. Darren, pause it here. Right. So now we're going to get into the actual imbalances themselves. And basically, many of the key components of order flow analysis involves around analyzing things such as absorption and that, but also imbalances, locating where there's significant differences in transactions between buyers and sellers at a given price. So by that I mean, we use this as an example because this is a really good, easy way to see it. So we can see there's straight away masses of imbalance here on the sell side. There's no contracts traded here on the ask, and there's contracts here. So there's an imbalance in price, massive imbalance. What the percentage is for the effectiveness of aggressiveness, that's very debatable and very subjective. I mean, basically, different people have differing opinions. So you could have sort of imbalances of, say, 200% difference, whereby one side is 200% stronger than the other side, or you could go, you know, up to 400%. It's very subjective. But what I like to see basically is a significant difference between the volume of buyers and sellers, or sellers and buyers, in order to feel that we've got a, you know, an aggressive participant moving the market. So also we can get singular imbalances of a significant size. I want to find you a quick example here. Let's use that one as an imbalance. Or you can get, which is what I prefer, stacked imbalances, where there's over given price range multiple imbalances taking place. And then that forms what we call a stacked imbalance. And as such, I have set this study up to show and print stacked imbalances of over 200% over 4 price ranges. So whenever that happens on the charts, it will print a box, a horizontal box, to show that there's been stacked imbalances. Now, this stacked imbalances can show up at random places all over the chart, but I only particularly pay attention to them at key area of interests when certain things have been happening at that point of interest, i.e., we'll go into it in a bit more in another video, but to generally help you out here understand, we're looking for like high volume, high buying into the area of interest, absorption taking place, with passive limit orders getting filled and then turning into aggressive transactions from the market participants, which then drive the market and cause the imbalances in price. So there's specific things I look for at points of interest, which I'll show you examples in another video, of what I look for, which is a classic sort of reversal scenario that I like to see. Because basically passive orders don't move the market. It's when those passive market participants, i.e. institutions, passively buying with their iceberg orders, when they then have got all those orders filled, they then become aggressive market participants, and that's what moves the market. Anyway, so let's use this as an example. As we're on it, we can see we have a stacked imbalance here. We can see that there's been significant transactions taking place within this candle. That's the volume. So a lot of volume taking place there, and a lot of sell delta, stacked imbalance. We like to see that. And then the market then generally will move away. And then if it pulls back into this stacked imbalance to fill the stacked imbalance, these aggressive market participants that were passively in the market, if they're still in the market, would then, we would hope, look to defend their positions or add to their orders and then fuel the market to drive even lower. So here we can see we had aggressive buying into the area. We then had a switch in order flow to the sell side, creating a stacked imbalance. We came back up, tested it, started auctioning down again. And then look, something's happened here. So there's that stacked imbalance, partially filled, still got a little bit there. Tapped right into it. There might have been news perhaps or something, because you can see there's a big spike. And then look at the rejection there. So we came down, up into that area, and then massive, really fast rejection, aggressive rejection from that fill of that imbalance. And then the market, let's move this out of the way, sold off. Let's just see what his price was. 27.10. And then we sold off 26.70. So 40 odd pips. And we can probably see on the day TPO context for if this was at a point of interest. Just for a bit of context. Yeah, so we had come up, swept the high from this profile here. Rejected that pullback into the imbalance. And then the market sold off. Looks like it actually sold off for the rest of the day. Yeah, sold off. Here we can see another example by the looks of it. So again, buying into the area. And again, look, significant differences in price. So much larger volumes here of aggressive sellers. So creating the stacked imbalance at VWAP as well, we can note as well, look. And then we come back and retest it or not. Coming back up to retest it, increasing buying into the imbalance. And then at the imbalance, look at that aggressive selling taking place again. Then are we going to auction down? And then we start auctioning down. As you can see. Again, you had a little one lower down. As you can see, massive imbalance again. Got defended, price dropped again. Another 30 odd pips. I think if I remember rightly, 40 odd pips. and then we might get a reversal. And then there's a transition to buyers, and then we get the pump back up. So that's how we can use imbalances and incorporate it into our trade plan, but especially at points of interest where we see for buying for a sell reversal example, we want to see like aggressive buying into the point of interest for an increase in volume, switch to the sell side, some absorption we'd like to see, which I'm going to cover in another video, absorption. And then we want to see that absorption from the passive limit orders getting filled, transition to aggressive selling by market participants, which can then cause imbalances in price or price inefficiencies as it then drops lower fast. And it can create opportunities to scale in positions or add positions on pullbacks to that kind of area. I think that's all we're going to cover on the imbalance side of this. Next video is going to be absorption.